All right, everybody, this is a webinar on deal structuring. We're going to run through a couple of different deal structuring methods, deal structuring options. And for us, we believe this to be a big part of our value proposition when we're speaking with our clients. We view deal structuring as a way to overcome various different obstacles throughout one of these transactions. That could be gaps in valuation. It could be different cash requirements in terms of what the seller is looking to get and what the buyer is willing to put up. There's a lot of different roadblocks that a properly structured deal can overcome. So really, a good deal structure is focused on aligning goals. For us, obviously, it's always about minimizing our client's risk and then maximizing their sale price for their business or their business asset. It also helps us widen the pool of potential purchasers. So by offering seller financing, offering earnouts, offering flexible structuring terms, it limits the amount of cash, or minimizes, I should say, the amount of cash that a potential buyer may need to bring to the table. And as a result, it allows us to sell a business faster and get the best possible outcome or achieve the best possible fit for our client. Those expanded methods really make everybody's lives a bit easier. The buyer's life becomes easier. The seller's life becomes easier because they're getting rid of something faster. And for us, it opens up a lot of options in terms of how creative we can get to make sure that everybody wins. There's three common methods when we talk about deal structuring. There's a few other ones that are slightly more complex that you'll start to see on bigger deals. And frankly, most commonly, there's some combination of the various methods being kind of crunched together and some sort of amalgamation is the end result. Traditionally, you have all cash at closing, a total buyout. Very straightforward, very, very rare. It's high risk for the buyer. I see a typo in this PowerPoint, but it's high risk for the buyer, very low risk for the seller. There's also a significant tax burden that can be created as a result of doing something like that for the seller. Generally, and we'll talk about this here in a few seconds, sellers sometimes have an expectation that, I'm going to sell my company for $100,000 or for $5 million, whatever the number may be. And if it's the first company they've ever sold, if they haven't done this a couple of times, not sort of a serial entrepreneur or private equity group, that's something that we need to sort of speak to them about and sort of, discuss expectations in terms of how realistic something like that actually may be. And in most cases, it's frankly quite rare. Probably the most common deal structure is going to be cash plus debt. So think of it like you're buying a house. You're putting some sort of down payment onto the business. And then the remainder is going to be financed generally by the seller. When we're kind of discussing it this way, a lot of times the cash contribution that's being made to a deal or the cash that a seller is receiving may also be financed. So, for the sake of argument, if it's a $100,000 deal, the seller wants $25,000 up front. Maybe $15,000 of that is coming from the purchaser's own, cash reserves. It's liquid. Maybe the remaining chunk of that down payment is coming as bank debt. And then obviously the scale is sliding. Maybe it's the opposite, 75% up front, 25% is carried back as seller debt. But generally, that's the structure that you're going to see offered. Traditionally, savvy buyers are going to ask for large chunks of seller financing, 50+%. On smaller deals, that's not totally uncommon. It's because the buyers want the sellers to keep some skin in the game. It also is because a lot of banks get weary about lending on some of these small businesses, particularly ones that don't have a large number of fixed assets. In many cases, they have none, or the buyer maybe doesn't have the strongest of personal financial statements. Debt on these things as a result of kind of those reasons can be hard to obtain. It can be costly to the buyer, but the alternative is, if there isn't a big cash deposit or they aren't able to obtain bank debt and the seller is lending quite a bit of money or carrying back some debt to make the deal happen, it is obviously a higher risk for them moving forward in the event that the buyer defaults and runs the business into the ground in a worst case scenario. Finally, And this is fairly common. We see it mostly on larger deals or when the valuation is very different in terms of what the buyer and seller think a business is worth. We'll see an earnout. And I'll talk more about that here in a second. But they're fairly rare. They're high risk. Another typo here. High risk for the buyer. Low risk for the seller. And I think that's actually in here backwards. It's high risk for the seller. It's low risk for the buyer. So please disregard what we have up on the screen in front of you guys. So again, it's high risk for the seller, low risk for the buyer. And basically the premise is that the future payouts are going to ultimately be predicated on the business's ongoing and future performance. So you may be getting some cash up front. You may, as a seller, be getting some guaranteed monthly payments, which are true debt. And then the remaining money that you're owed, part of that sale price, is going to be paid out, assuming that the business continues to be profitable, continues to perform. There's several ways that it's done. Generally, there will be something that's called a hurdle, where the company needs to profit, for the sake of argument, $100,000. And then over that $100,000 mark, the previous owner, or the seller in this scenario, gets paid either a percentage or a fixed number every single year or monthly, in the following year. So it's a great deal for the buyer because it mitigates the risk for them. It minimizes the amount of money they absolutely have to pay in a worst case scenario back to the seller. But alternatively, if there's large discrepancies in terms of what people think a business is worth, that's generally because the seller believes there's some unrealized potential, or that there's something that's going to change in the future. They signed a new contract, et cetera, et cetera. A lot of times buyers don't want to pay for this sort of, speculative idea of performance, basically gambling on something that may or may not happen in the future. This earnout structure is incredibly useful there because it allows everyone to win. The buyer says, okay, we'll in theory give you the number that you're asking for, a higher valuation, but we're not paying that money to you, or we're not paying all of that money to you unless your business continues to perform, and a lot of the things that you said would happen actually do. Going back kind of into detail into some of these things, so all cash at closing, like we said, very, very rare. You'll see this in sort of really big deals or really small deals. So if you're selling, a $50,000 Sweet Frog franchise, which hopefully no one on this, conference call is actually doing, you may see something like that because it's quick, it's dirty, someone's going to stroke a check for it. You may see it also on larger strategic purchases where you have a really, really well-capitalized group that's, a small private equity fund or a family office that says, okay, you know what, I own 10 real estate brokerages, and here's another one that I want to buy. I'm going to pay cash for that new one because I don't need the debt. It's just quick and dirty. I'm going to buy it, and we're going to be done. So you'll see him again on some of those larger strategic purchases. You'll see him on with the well-capitalized buyers, and then you'll see some on the small deals where, nominally the number that we're talking about in terms of enterprise value or sale price of a business isn't that high. So 100,000 or less. Sometimes it's a little bit more than that. But on a case-by-case basis, statistically looking at, our listings as an example, that's going to be very rare. So once you start to get over $100,000, $150,000, and unless you have a very specific, strategic purpose or purchase that's being, executed by a well-capitalized buyer, you're not going to see that. So those, normal $1, $2, $3, $4, $5, $10 million deals, you're not seeing that. The reasons, listed below: high risk for the buyer. The buyers, in a lot of ways, are the ones that are kind of controlling that risk factor. They're the ones that are usually controlling for it, trying to mitigate it. So they're not going to walk into a deal and, stroke a check for 7 figures if they can get it financed and minimize their downside. It is ultimately low risk for the seller. And as I mentioned earlier, many, and I even put most in here, many small and or first-time sellers, kind of both categories, have this expectation of all cash at closing. So it's, hey, I'm ready to retire. Somebody write me a check for $1 million so I can ride off into the sunset. That's really not how it works, or very infrequently does it actually occur that way. So just something that we need to qualify with our sellers and say, look, just so you got a $500,000 company here. You got a $5 million company here. The odds of you getting a check for all of that are slim to none. That being said, all cash can technically come from different places. So sometimes you'll hear a deal referred to as all cash. So let's say we have $1 million deal. What may actually be happening is the purchaser is injecting 20-25%, let's say $200,000 for the sake of argument, and then they're getting bank financing for the remainder. That 20%, the actual cash contribution that they're putting in, if it's bank financing, and you can kind of refer back to our Understanding Bank Debt for Acquisitions webinar, generally in that scenario is going to be true liquidity. It's actually coming from liquidated stocks or a checking account or a savings account or whatever. Sometimes it will come from a home equity loan, a 401k rollover, which ultimately is true liquidity, but very rarely is it financed. But sometimes, again, in the eyes of the seller, what is being viewed or called all cash from the buyer's perspective may not actually be. So again, if there's a bank note for $1 million, the seller's walking away with $1 million in cash. The buyer isn't viewing that as an all cash deal. They're actually getting financing. So just kind of keep that in the back of your mind. Even though the seller may be asking for all cash, that doesn't necessarily mean that the buyer is stroking a check out of their bank account for the desired value of the company. It could be coming from a bank or some other lender. Cash plus debt, probably the most common deal structure, as we mentioned before, can come from a variety of places. I do encourage you guys, especially if you're going through this webinar and you kind of are learning about the deal structuring, to go back and reference our Understanding Bank Debt for Acquisitions, because there are some nuances to this that we're not going to touch on here. Bank debt, SBA term loans, traditional bank term loans. There are some private, non-traditional, non-bank lenders that have popped up, generally higher interest rate, tougher terms, hard to qualify for, et cetera, et cetera. Generally, though, debt's coming from either a bank, usually the SBA on some of the smaller deals, some of the bigger deals where, again, they're fairly well-capitalized groups or fairly sophisticated buyers. They may have a good banking relationship where they can just get a regular term loan, or seller financing, which on the smaller deals, and we'll say we'll call those anything under $2 million. Seller financing is a major part of the deal structuring, and it's not uncommon for people to ask for 50%, 40% carryback from the seller to make sure that they have some skin in the game and that the purchaser can actually get that deal done. Occasionally on larger deals, and this is going to be $5, $6, $7, $10 million, where you have a couple $1 million in discretionary earnings or free cash flow, you'll see private parties come in where a private equity fund or a family office or some sort of investment group is making a loan to lock in some sort of baseline return. Again, uncommon unless you're talking in the $5 to $10+ million enterprise value or sale price range. So just keep that in the back of your mind as well. Various terms and structures. Banks, usually 3 to 7 year terms. Rates generally pegged against prime. Obviously depending on credit worthiness, the industry and type of business, and all different things. Seller financing, really the seller can kind of punch their own ticket here. The buyer's obviously going to come to the table and try and negotiate a certain type of deal. There's really no standardized term or rate. Generally, they're going to be 5 years. They're going to be a little bit shorter. If it's a bigger deal, sometimes it'll get stretched out 7 or 10. It's really all about the negotiation. Rates generally are pegged against prime. Sometimes they're fixed rates. We're actually seeing that more and more, just a fixed 5%, a fixed 6%. Occasionally, you will see people that say, hey, we just, no interest. You can just pay me back. That's actually not allowed. There's an IRS minimum interest rate. So sometimes we'll see that. I think right now it's like 1.98% or something like that. Don't quote me, but that's something the accountants can discuss. But there has to be an interest rate charged. But beyond that, the term, what the rate actually is, whether it's fixed or floating, all points of contention. Anything can be negotiated. Everything is on the table. Personal guarantees are almost always required on a bank. And when I say almost always, I mean like 99.9% of the time, unless you have a very, very hyper-qualified company that owns, multi-million-dollar properties and assets and everything else. They may be able to, kind of slide by without one. Generally, we see them. On the seller debt, the sophisticated buyers, the more well-capitalized buyers are probably going to push back on the personal guarantees. Ultimately, it's up to the seller. We obviously always recommend that we have personal guarantees if possible. There are certain transactions, especially bigger ones, where you have a sophisticated buyer coming in and everyone's pretty comfortable with one another, where we say, look, it's ultimately up to you. You're probably okay without one here. But as a rule, it is always highly recommended that the seller ask for a personal guarantee on whatever seller financing they are willing to carry back. Debt is incurred for pretty obvious reasons. Generally, it minimizes the cash required for a purchase. So especially on some of these bigger deals, if it's $1 million deal and they need 25% to do it, that's still $250,000. And regardless of how well capitalized somebody is or a firm is, that's still a lot of money nominally. Alternatively, on some of the smaller deals, it's simply a means thing. People may be a good fit for the business, but they may not have that $100,000 to put down on a $500,000 deal, so on and so forth. So this minimizes the amount of cash that's required for a purchase. And additionally, and arguably just as important, for the buyer, it allows them to be cash flow positive pretty much day one without tying up a huge chunk of their money. So most strategic buyers, definitely private equity groups, people that own more than one business, this is arguably the most important thing to them. You're certainly going to be cash flow positive if you stroke a check and pay for 100% of it, but they want a little bit of leverage. They want to allow some of their money to remain liquid. So earnout, like we kind of were discussing previously, still is going to require a down payment. So structurally looks fairly similar to traditional debt, kind of straight line debt, except that it's dependent or it's predicated on the future business performance. So those payments are not made, or parts of those payments are not made, depending on the structure, unless the business continues to perform. So again, often used to bridge large gaps in buyer and seller valuation. So you have seller who says, look, I think my company's worth $5 million. Buyer says it's worth $3 million. And the seller saying, well, look, I just signed some of these contracts, or I have a new product that hasn't come to market yet that we just received our patent on, or whatever. This is a great opportunity to say, okay, look, we don't mind giving you a little bit of upside, but you're only going to make that extra $2 million in that scenario if the business continues to perform and does start to hit some of these metrics or some of these revenue and EBITDA targets or discretionary earning targets that you've actually kind of laid out and indicated may be possible. So these earnouts are going to be very low risk for the buyer, right? Minimizing the downside, minimizes the amount of money that they have to pay out in a worst case scenario. Very high risk for the seller. You may get that higher valuation. You may get that, $5 million sale price on a piece of paper. But if you're only realizing $3 million of it, it can be high risk. So generally, and especially nowadays, earnouts are much more common on larger deals where the businesses are strong. The owners, the current owners or the sellers in this scenario don't mind doing an earnout because they feel confident that it's going to continue to perform. But on smaller deals, it's less common just because there's not the same growth potential oftentimes, and the sellers, frankly, don't understand it or want to move forward down that road. So we see a combination of these deals a lot where it's, cash down payment, some straight line traditional debt coming from a bank or coming from the seller, and then maybe 10, 15, 20, 30% of the deal coming as an earnout. So a pretty interesting option, but generally we're just seeing it as a piece. So this deal structuring webinar as a whole is fairly complex. This is sort of the meat and potatoes from our perspective of what we do. This is definitely deal structuring 101. There are some other options that we haven't discussed. Dividend recapitalization, which is a very specialized option for larger businesses, generally private equity held, not going to be that useful for individual buyers. Waterfalls. There's some other options that we can discuss more on a case-by-case basis. We'll probably put some webinars out on them for those of you who are kind of operating in that $5 to $10 million enterprise value range. But at a high level, this is the stuff that you're going to see on the day-to-day for the average deal, $500,000 to 5, 6, 7, 10 million. If you guys have any questions, please feel free to ping myself, ping Sylvia. This is inherently pretty complex, so we'd be happy to walk through this with you one-on-one, answer any questions you have, talk specifics on deals, so on and so forth. With that being said, this PowerPoint is available for download if you want to kind of flip through it and kind of go along on your own. Otherwise, again, we are available basically 24/7 at this point. So you guys give us a shout whenever you need.